Good afternoon and welcome to our Nonprofit Accounting and Tax Update webinar. I'm Donella Wilson, Nonprofit Practice Leader at GHJ, and I will be moderating today's panel discussion. Joining me are my colleagues Liz Navarez and Amy Ibsen, as well as Yulia Mazeva, a GHJ alum, now with the AICPA. Liz leads our nonprofit tax practice and is our tax expert today, while Amy and Yulia are our technical experts on the accounting side. Full bios are available on our website and in the materials that will be sent out after today's webinar, along with the recording. We will be covering a range of topics today, as noted in the agenda on the screen, and our goal is both to provide guidance and provoke discussion beyond today's webinar. If you have questions, please drop them into the Q&A. And if we are not able to address them on the webinar, please reach out to one of us afterwards. So let's jump right in. According to a recent Nonprofit Times article, crypto donations skyrocketed in 2021. So we're going to start there. Although it has been a rough start to 2022 for cryptocurrency, as it has been for the stock markets. So it remains to be seen what this trend will be in 2022. Liz, starting with you, what tax reporting requirements do nonprofit organizations need to be aware of?
It's important for organizations to understand that this virtual currency is actually treated as donated property to nonprofit organizations, meaning if you do receive this cryptocurrency and the value is more than $5,000, the Form 8283 is actually required to be completed. And if you're not sure what the 8283 is, it's actually a form that's completed by the donor, normally requires an appraisal for property, let's say it's artwork or other type of non-cash items, in which the donor gives it to the organization to sign and just certify that you did in fact receive that donation. You're not verifying the value of this item. Again, you actually need to get an appraisal, or that individual donor needs to get an appraisal and then report the value of the 8283. They're just giving it to the organization as a form of acknowledgement of the donation. Likewise, if this cryptocurrency is sold within 3 years, it will also require the Form 8282. And again, this is whenever you sell this donated property within 3 years of the original receipt. This form lets the IRS know how much you actually sold that donated property for. So this is actually also required with this cryptocurrency whenever you do end up selling that. Another item to point out, the individual donor must actually have held the donated cryptocurrency for at least a year in order to get a fair market value of the donation. If it's held less than a year, they actually only get the lesser of their cost basis or their fair market value. So it's important to let the donor know of these potential restrictions and charitable deductions.
Thank you, Liz. And Yulia, Liz mentioned that crypto donations are treated as donated property. How are donations of cryptocurrency classified on the accounting side?
Thank you, Donella. So although in practice, some of us have been investing heavily in cryptocurrencies and enjoying the rated investment returns, or more likely suffering losses, from the accounting standpoint, it's not actually classified as an investment. So it doesn't represent cash or cash equivalent. It's not an equity interest. It's not a contract to receive a specified amount of cash. So as a result, it's really a non-financial asset, or more specifically, an intangible asset. And because it doesn't expire, it is presumed to have an indefinite life. So from an accounting standpoint, when such contribution is received, you would actually record it at a fair market value at the time of the donation. Then subsequently, no amortization is taken, as it does have an indefinite life, and instead the entity would evaluate the cryptocurrency held for impairment. If you do realize that there is impairment in the value, that value should be written down, but make sure you don't write it up. That is not allowed. And then The last point I wanted to make on this is that most nonprofits gift acceptance policies do not actually cover contributions of cryptocurrency. So we really recommend you take a look at your policy and update it for such contributions. That the policy should outline whether you accept such contributions or not. And if you do, what you do with them. Do you sell them right away or do you hold on to them? Because of how volatile cryptocurrency is, what we anticipate happening is that most nonprofits will not hold cryptocurrency and will try to sell it as soon as possible. And when you make these decisions, be sure to involve your board to help you identify the appropriate policies.
A good caution there, Yulia. Now, if the organization receiving the cryptocurrency is holding it or happens to be holding it at year end, maybe there's a delay in liquidation, where would that cryptocurrency, excuse me, be presented on the statement of financial position?
It would most likely be presented with other assets or intangible assets, depending on how material it is and if you want to draw attention to cryptocurrency held or not. But most likely it will be with your intangible assets, and you would have to actually disclose the related required items pertinent to intangible assets.
Thank you. Now, Amy, what are we seeing in practice, or what are you seeing in practice?
So despite the fact that cryptocurrency donations are increasing, many banks still won't accept crypto. So if your bank is one of those, there are still a few ways that your nonprofit can accept cryptocurrency donations. So the first is you can accept donations directly. The second choice is you can accept through an intermediary 501c3. And then the third is you can use an embedded checkout process directly on your website. So if your nonprofit would like to accept crypto directly, a cryptocurrency donation processor might be a good option for you. Many of these processors can help to do multiple things like automate receipts, actually convert the currency to cash, and accept donations into your nonprofit's cryptocurrency wallet. Donation processors also sometimes help with marketing or fundraising efforts, and the Giving Block is an example of one of the larger cryptocurrency donation processors. If your nonprofit does not want to accept crypto directly, like I mentioned, the second option is to use an intermediary 501c3. And a common example of this is a donor-advised fund. This allows a nonprofit to accept donations without actually taking custody of the currency. And the intermediary is responsible for sending tax receipts, filing those IRS forms that Liz mentioned, and also converting the cryptocurrency to cash, as well as following the ever-changing regulations around this area. And then the third option I mentioned is using an embedded checkout experience through a crypto exchange. And for a fee, crypto exchanges can offer checkout experiences that you can actually embed into your own website. And while this is typically cheaper than the specialized donation processors I mentioned before, the checkout experience is not created with nonprofits and donations in mind. So your organization would need to be cognizant of coordinating donor support, tax receipt creation, and collection of donor information. And donating cryptocurrency can result in lower transaction costs. For example, credit card fees are not applicable, and overseas donations may also be easier as there aren't foreign exchange or international financial regulation considerations.
Well, clearly advanced planning is needed. And we haven't seen a significant volume of cryptocurrency donations with our client base so far, although it appears that some donors have certainly wanted to make these types of donations. Cryptocurrency, clearly, having listened to Liz and Yulia and Amy, is a complex asset that is challenging to value and hold and liquidate. And so if there is low tolerance for risk and complexity, the outsourced third-party service provider solution that Amy mentioned likely will be preferable. And I think it's now time for a polling question. So if you want CPE, you do have to respond to all three of the polling questions that will be popping up today. So it's on the screen now. And while you respond to that, we're going to continue on. And since we've just been talking about contributions in kind, let's touch on the new accounting standard for contributed non-financial assets. So Amy, back to you. The new ASU 2020-07 has a deceptive title. Can you elaborate on what is in scope for this standard?
Sure, Danella. So the ASU uses the term contributed non-financial assets rather than gifts in kind, which is the terminology we're all used to. Gift in kind is a broad term and is actually not defined by the FASB accounting standards codification. However, the FASB ASC does define both contributions and non-financial assets. So therefore, that terminology is used in the standard. And as you can see on this slide, there's various things that are included within the scope. So just a few examples: fixed assets, use of fixed assets and related utilities, materials and supplies, intangibles. And I also wanted to point out that contributed services are included in the scope of the standard. And while your nonprofit may already separately report gift in kinds, and you may already make some of the disclosures that are required by the ASU, the purpose of the new standard is to bring presentation and disclosure consistency across all nonprofits. And in practice, the FASB does expect that some nonprofits will continue to use the term gift in kind, and flexibility in the labeling of financial statement line items is permitted by the standard.
So Amy, and I think this is an important point that you made, because this is a new standard. It's not asking nonprofits to change their methods of valuation. It just increases the disclosure requirements, providing greater visibility into the makeup of in-kind contributions.
That's right.
Thank you. All right, so what are these disclosure requirements and when is the standard effective?
Sure. So I'll start with the disclosure requirements first. So as Danella mentioned, the ASU does not change the accounting for gift in kinds, just matters related to presentation and disclosure. The ASU does require nonprofits to present gift in kinds on a separate line item on the statement of activities, separate from contributions of cash and other financial assets. And as you can see on this slide, it can either be shown on the left as a separate row or on the right as a separate column. And the purpose of this is that financial statement users want to know how a nonprofit is funded and how much of that funding comes from cash, other assets, and how much from gift in kind. And please note that although the separate row presentation does not require disclosures of related expenses, the column presentation does. And if we can go on to the next slide, there's additional disclosure requirements of a disaggregation of the amount of gift in kinds recognized within the statement of activities by category that depicts the type of gift in kind. So as you can see here, for each category of contributed non-financial asset or gift in kind, nonprofits should disclose a few key things. So as you can see in the third row, qualitative information about whether the gift in kind were monetized or used during the reporting period is required. And if used, the nonprofit should disclose a description of the programs or other activities in which those assets were used. And the next is a description of any donor imposed restriction associated with the gift in kind, which is shown in the next column. And finally, a description of the valuation technique and inputs used to arrive at the fair value in accordance with the requirements of FASB ASC 820 fair value measurement at initial recognition. And in terms of the timing of implementation, so the ASU should be applied on a retrospective basis. Early adoption is permitted, and as shown on the slide, this is effective for annual periods beginning after June 15th, 2021. So for those of you with fiscal years, June 30th, 2022 would be effective then, or for calendar year ends, it would be effective for December 31st, 2022.
Thank you, Amy. So it's a good idea to start thinking about how you plan to present those additional disclosures in the financial statements now, so that every stakeholder has a chance to weigh in on the presentation. Liz, what about a reminder on the tax side? How do these types of in-kind show up on the Form 990?
Yes, it's very important to understand that there are differences. This is one book tax difference that we do have to take into account. Normally, in-kind services and donated use of facilities are not included on the Form 990 as revenue or expenses. We do back it out. The only thing we include within the Form 990 are donated goods, because in theory, donated goods are items that individuals could take a charitable donation for. Unlike in-kind services or use of facilities, you're unable to get that charitable deduction. So this disclosure, I think, is going to make our lives a little bit easier, at least on the tax side. We're able to get that additional detail within the footnotes of the financials, because that is a required disclosure on Schedule M if your in-kind donations were greater than $25,000 for a given year.
Thanks, Liz. It's a good reminder, because I think often we encounter users of financial statements and the Form 990 who don't understand that that is actually one of the primary differences on the accounting tax difference side. So sticking with revenue, we're now a year or so into the new revenue recognition standards. And turning to Yulia, what are some of the common pitfalls on implementation that you have observed? And what tips do you have for interpreting contracts?
It definitely feels like revenue recognition has been a significant focus over the last couple of years with the implementation of the standard, especially ASU 2018-08, accounting for contributions received and made. And so one of the biggest challenges that we have seen organizations struggle with is really understanding the distinction between a condition and a restriction, especially considering sometimes the grant agreements or pledge agreements are not really specific in how they express those terms. So just as a reminder, for the condition to exist, it must have both a barrier that must be overcome by the entity and the related right of return or release. And so that right of return or release needs to be tied back to the barrier. And some of the examples of the barriers would be your measurable performance objectives, such as specified levels of service, specific targets that you need to reach, limited discretion. For example, it could be limits on the types of activities that could be funded by the contribution, or limits on the expenses that you could incur under the terms of the grant. And then the last one would be stipulations related to the purpose of the agreement. And the standard actually identifies several items that would not be barriers, and those include administrative stipulations. So if the grant agreement requires you to file a progress report or closeout report to outline what you have done as a result of receiving the funds, that's really administrative in nature and would not make a barrier. Another example would be passage of time. So that is when your pledge agreement would specify payments to be received by certain dates. That is not dependent on the entity's performance, so would not be considered a barrier. And then the third example is adherence to budget. So if you think about applying for a grant, a lot of grantees actually have to put together a budget outlining how they will spend the funds. So unless that grant agreement really incorporates that budget and limits discretion on spending outside of the budget, it really would not be considered a barrier. What you have to keep in mind is that each grant agreement has to be evaluated on a case-by-case basis. And if the terms are ambiguous, the standard does say that you would default to the conditional treatment. Another item to mention here is the simultaneous release policy. The clarifying standard, ASU 2018-08, really changed their mindset about how we treat government grants. Government grants under the standard are most likely going to be conditional contributions and at times restricted. So technically, when you meet those conditions and you record that income, it has to be presented in a with donor restrictions column. And then you would show the release of the funding once the restrictions are met down as a separate line. To avoid this bulky presentation, what we have seen entities do is adopt the simultaneous release policy, which indicates that any conditional restricted contributions received for which conditions and restrictions are met in the period the funds are received would be treated as contributions without donor restrictions. And so then as a result, you would be able to show both income and expenses in the same column. And note, if you do adopt that policy, you would not have to adopt a similar policy for your other restricted contributions.
And that simultaneous release option is one of the reasons why I think when we look at organizations that have government funding, that have had that pattern of recognition in the past of cost reimbursement, that they still have the same presentation in their financial statements in the without donor restricted column. Just a couple of things I wanted to pause on in going back to what you mentioned about the budget. So there really has to be something in addition to just a budget, such as a requirement to incur qualifying expenditures. There would have to be that in place in order for a condition to be considered, correct? Right, such as, yeah.
Yep, that's correct. Because really a budget put together by the entity is not something that the donor imposes. It's the entity making those guidelines for itself. And then if the donor does limit discretion to spending, such as, really outlining non-qualifying items that can be charged to the grant, in that case, it might be part of the condition.
Got it. So when you think about government contracts and where there's a requirement to incur allowable costs under a cost reimbursement contract, for example, with a budget, then that would create that condition. I was also thinking of another aspect that sometimes gives us pause. Most foundation agreements, as a standard legal practice, have a clause related to a right of return. But the key there is that it really has to be directly linked to the meeting of a condition rather than just having aspirational goals in the contract. If those conditions are not directly tied to that right of return or release, then there's no condition. Amy, what additional reminders do you have?
So if we could go into the next slide, just a reminder around ASC 606 for those of you who have revenues that fall under that standard. So the standard does require the disclosure of revenue that's recognized at a point in time. So for example, if you meet a specific deliverable in a contract on a certain date versus over a period of time. So for example, if control passes to your customer over the term of the contract, let's say. So while the specific terminology, point in time versus over time, does not need to be explicitly used, remember that the information does need to be included in your disclosures and financial statements.
Thank you. And I believe it's now time for another polling question. And for those of you who did manage to see the results of the previous polling question, I'm sure it was no surprise to you that I think this is universal, that attracting, developing, and retaining staff is the primary concern for 2022. All right, so the accounting side has been very busy, as you've heard, but let's turn over to Liz now, who's fresh from the Georgetown Conference for Tax-Exempt Organizations, for an update from the IRS.
Thanks, Daniela. So in terms of updates on the compliance side, the IRS is really looking to strengthen overall compliance activities within the department. So they are actually looking to really collaborate with other departments, such as the high net worth individuals, in which, for example, they would go in and do an IRS examination on the high income taxpayer, and then would also look into any potential related private foundations that individual may be involved with, or other types of entities. So again, using their different departmental resources in order to target different areas and work together. So they are definitely increasing their hiring within the IRS as well in order to achieve this. Another area that they will start looking into is the employer tax credits. They are actually extending the statute of limitations on payroll tax filings, which is normally 3 years. They have extended it up to 5 years, again, to allow them additional time, if needed, to go back and audit some of those credits that are being claimed. A couple of updates on the data-driven examination. So this is a new process that the IRS started last fiscal year, in which, depending on the information you were disclosing on either your Form 990 or your Form 990 PF if you're a private foundation, they would run different queries based on the information and generate tax audits based on this. And as a result, these audits ended up with an 87% change rate when they went in there and did audit these organizations. And some of the areas in which resulted in change was one, worker classification, in which organizations were, for example, treating an individual as an independent contractor. And in fact, they were really employees and should have been issued a W-2 employees. So payroll taxes is always an area in which creates additional revenue for the IRS. And whenever an organization is audited, they ensure to look at these types of worker classifications to ensure organizations are doing it appropriately and paying the correct payroll taxes. Another area that they are going to look into as well is if an individual receives both a W-2 and a 1099 miscellaneous within the same taxable year to see whether it was accurately done. Again, was that individual still having the same job responsibilities and activities? Often we see this when, let's say, a CEO retires, but they stay on as a consultant potentially and still get paid. So again, really ensuring that you're looking at what that criteria is when you are classifying these individuals to ensure that they're appropriately classified and the accurate reporting is being done. Another area is unrelated business income. Again, this is another revenue generation for the IRS when there's any unpaid tax, or if the organization is having unrelated business activities and not reporting them as such. This, would generate additional tax for them. Or if you aren't documenting expenses accurately in terms of how you are allocating your expenses between your program services and unrelated business income activities, ensuring that you do document that appropriately. I actually recently wrote a blog in regards to the final regulations on siloing rules, where you are now required to break out and separate different unrelated trades or businesses. So we will include a link to that within the slides. Another area is self-dealing. So this is self-dealing that may occur with officers, disqualified individuals. Again, there's a potential tax, excise tax that is imposed in some of these self-dealing transactions. So this was another area of focus during the IRS examinations. Another thing I wanted to point out was in regards to the Form 990 filing, the 990N. So this is an e-postcard that is allowed to organizations that normally have 50,000 or less in gross receipts. And it is created as an easy filing for them to do. And through other mechanisms, the IRS was able to determine that some of these organizations that had previously been filing these e-postcards actually had gross receipts greater than this amount, meaning they actually didn't qualify to do this. So the IRS is taking the position that this is a non-filing for the organizations. And if you're a nonprofit organization and do not file for 3 consecutive years, your IRS tax exemption actually gets automatically revoked. So they will be revoking these tax exempt status for these organizations that were inappropriately filing the Form 990N when in fact they should have been filing a different form, either the 990Z or the regular Form 990. So that's for the compliance strategy on the IRS. If we could move on to the next slide, we'll go through what is in their priority guidance plan. So this is looking into the next fiscal year. What are some areas that they're going to focus on? And one of them is providing guidance on which an LLC can actually qualify as a 501c3. So in the past, normally organizations that are incorporated either as a corporation or a trust normally are the ones that receive exempt status. So they are now allowing LLCs, limited liability companies, to receive exempt status. But one thing to note or look out for is that some states still do not recognize LLCs as entities in which can receive tax exemption. Again, normally it's either a corporation or a trust. So being careful if you are thinking of creating new entities, make sure you check your state regulations to see whether your state actually does allow for an LLC to receive that 501c3 status. Another area they're looking to issue more regulations on is the allocation of expenses for unrelated business income. Again, there's not too much guidance in there for how to allocate appropriately expenses when you have dual use assets, meaning you use, let's say, a building for both program services and unrelated business income, and how to document that. So they are looking to issue more clarification and guidance on how to best allocate some of those expenses. Another area is on private foundations and investments in partnerships in which a disqualified individual is also a partner. We tend to see this more on the private foundation side, in which maybe the private foundation and some of those officers and individuals, those family foundations, tend to have the same investment manager and have the same type of partnership investments. So they're just looking into providing some guidance as to, you know, what may potentially be considered a disqualified transaction with those individuals, and have potential excise tax implications as well. And lastly is some guidance on donor advised funds. I think this has been something that's been talked about for some time now on the donor advised fund side. So they're just looking to issue more regulations on excise taxes for that.
Thank you, Liz. Well, I guess the IRS has been very busy as well. Can you give us a quick reminder of what the employee retention credit is, specifically how to assess eligibility and how to claim? And of course, if you missed claiming the credit on the quarterly Form 941 returns, can you amend the quarterly returns? And finally, is there a deadline for amending?
Great. Yes. So the ERC is something that has been talked about for some time now, obviously, and it is applicable for tax year 2020 and 2021. For 2021, it's just the last 3 quarters. There was a revision where the last quarter of 2021 actually wasn't included anymore, and you couldn't claim the credit. But this is a credit allowed for organizations that either had a decrease in gross receipts, or there was a temporary suspension due to the COVID situation. And these credits are applied through your payroll tax forms. Organizations are actually allowed to go back and still file amended returns in order to claim these credits as long as the statute is open. So again, the statute of limitations at the moment is 3 years. They have increased it to 5 years. I'm not sure if that would allow that additional time to go back and amend, but again, you're still well within that time frame to link into whether the organization may qualify. I know there was some confusion with the PPP loan and double dipping. I think now that there's more clarification, we're definitely seeing more clients look into this credit and filing for those prior quarters that have gone back and filed those amended returns in order to qualify.
Thanks, Liz. And actually, we do generally think, and I think this is a sort of a sense across the board, that organizations probably, many of them probably were eligible, but haven't actually made that election. So it is something to go back and just reassess. Yulia, how should the employee retention credit be presented in a nonprofit's financial statements?
So if we move to the next slide, it will actually show that from the accounting standpoint, ERCs are considered conditional contributions within the scope of nonprofit revenue recognition guidance. And so conditional contributions would have certain barriers. And in this case, it's eligibility criteria, meeting those qualifying expenses, incurring the specific qualifying expenses, and then actually filing that amended tax return. So once those conditions are met, you would record a refund receivable and then related grant income. On a statement of activities, you would present that income then together with your government grants. Above the line, it's not netted against expenses. And then what we have also seen some entities do, especially if the credit is significant, presented as other income, as non-operating income, which is also allowed to really represent that it's not part of their normal standard funding from year to year. And then if the credit is significant, you should consider disclosing the terms and conditions of the award and risks and benefits.
So, and when you're saying filing an amended tax return, you mean the Form 941 payroll return. And on the tax side, Liz, let's just make sure we chat about the differences.
Yes, so we wouldn't go back and amend the Form 990s in order to reflect those credits that are applicable for either 2020 or 2021. We would actually recognize it in the year that the revenue is being recognized for audit purposes. The difference is that we're not picking it up as revenue on the Form 990. There is an FAQ that they issued in regards to the ERC treatment, and it specifically says not to treat it under gross income on your tax return. So we would report it actually under the expense side, whether it's either netted in against payroll expenses or showing a negative expense. You know, it's really, we have to see how best to report it. Definitely looking for some guidance from the IRS on nonprofits to see what's the best treatment. But again, we will report in the year that it's being recognized as revenue consistent with audit.
Thank you. So there will be a difference in presentation, netted against expenses for tax and then shown as revenue on the accounting side, but the timing will be the same. And also just wanted to make a comment here. The most important piece when we're looking at conditions is really that to meet the eligibility requirement. That is, of course, a primary overarching condition. But another condition is the actual act of filing that amended return or claiming the credit on the quarterly 941 return, because it's not automatic. So this would be another condition to consider. So if you filed your amended returns or you filed your quarterly 941 returns and you are eligible, then you're in the realm of revenue recognition. The one thing that we have seen just as a caution is that the ERC, in terms of actually receiving that credit, hasn't been subject to the same level of scrutiny as the PPP, which had to go through tremendous levels, as you all know, I'm sure, of proving the eligibility and also the forgiveness calculation. A lot of scrutiny went into that. It hasn't been the same with the ERC. So some caution there. Just making sure that the organization truly is eligible and is doing the calculation correctly to avoid any unpleasant surprises a little bit down the line. All right, so we're going to stay with Yulia actually for another CARES Act update, provider relief funds. And Yulia, could you remind us of what this funding is and who was eligible? Are there any new tranches of funding? Because no one ever wants to miss out on funding. And any guidance regarding the use of funds?
Sure. So Provider Relief Fund has definitely been a very challenging program to wrap our minds around due to the continuously updated guidance and then the mismatch of the reporting on the CFA and then to the HHS versus revenue recognition. So as a reminder, Provider Relief Fund was established by the CARES Act with additional funding available through the American Rescue Plan Act that actually happened over the last year. The funding is administered by the Health Resources and Services Administration, or HRSA, within the Department of Health and Human Services. And the funding was provided to hospitals and other healthcare providers to really cover expenses, healthcare-related expenses or lost revenues incurred as a result of the pandemic. And so those types of expenses would include your supplies, IT expenses, perhaps retrofitting your facilities to meet the new regulations in relation to the pandemic, some personnel costs, as well as other healthcare-related costs that they incur to prevent, prepare for, and respond to coronavirus, not reimbursed by other sources. So no double dipping was allowed. In terms of lost revenues, there were specific options on how to calculate that loss in revenue, with 2019 being your base comparison year. At this point, HRSA is no longer accepting additional applications for the program, unfortunately, or fortunately, because it's been such a challenging program. And then all the funds have been distributed as well. So if you look at the next slide, it will have that table with the periods of reporting, as well as periods of availability, and when you would actually report that funding on your CFA, because it is a federally funded program and it is subject to the single audit. So this table here represents expenses funded by provider relief funds to be reported on your CFAs for fiscal year end June 30, 2022. So if you do have that fiscal year end June 30, 2022, and you did receive provider relief funds during the period of July 1st, 2020 through June 30, 2021, you would be reporting those funds on US CFA in the fiscal 2022 year. So that is that mismatch, because from the revenue standpoint, similarly to employee retention credits, it's considered a conditional contribution. So once you meet the conditions, which really is incurring those qualifying expenses, once you meet those, you can recognize that revenue, but you would not be reporting it to the HHS or on your CFA until the year after, perhaps. And that's what we have seen a lot of challenges with our clients, and as well as, just different organizations receiving those funds.
Thank you, Yulia. And actually, your mention of a single audit reminded me of something. June 30, 2021 year ends were permitted to have a 6-month extension for the filing of their data collection form, but the OMB has come out very clearly to state that there will be no further extension. So for all year ends after 6/30/2021, alas, we're back to the 9-month deadline, no additional leeway provided. All right, and I think we're at another polling question. So as a reminder, you have to answer all 3 to get your CPE. And this is quite a long list, but this is for us to determine any future webinar and blog topics as well. So thank you for your time responding to this polling question. We've already covered a number of technical matters. And so now we're going to think about what's next on the horizon. So we've covered ones that are in place now, but what's coming down the line? And we'll start with Liz. What's news on the Hill?
Thanks, Danella. And again, I want to emphasize these are just proposals. Nothing has passed as of yet, but it's something to keep in mind for planning and so forth. So the first one is on the Green Book proposal, which is actually Biden's proposal on some tax legislation changes. The first one actually impacts private foundations. So currently private foundations are allowed to distribute funds to a donor advised fund, and these distributions actually count towards their 5% minimum required distribution. And what this proposal does, it actually requires these DAFs to redistribute the funds within the end of the next tax year in order for the private foundation, in order for it to treat it as a qualifying distribution in the year it transfers the funds to the DAF. So it's adding that time limit to these DAF distributions, because they don't want to have just, private foundations try to meet their 5% and then the funds just sit in a DAF and don't go out to other charities. They're just sitting there. So this is really, the purpose of it is, again, to keep the funds moving to the charities. Another item is a change in the corporate tax rate. So there is a proposal there to change it from a 21% current rate to a 28% rate. And this will impact unrelated business income tax filers. So if you have UBIT, this would impact you because you would be paying that tax at that higher corporate tax rate if it does pass. The next one is on the Accelerating Charitable Efforts Act, or the ACE Act. And this has a lot of wording on donor advised funds and changing the way donor advised funds actually work. Currently, there's about 140 billion worth of assets sitting in DAFs throughout the US. And what this proposed act does, it creates a qualifying DAF in which it limits a 15-year life for the DAF. After 15 years, all the assets must be redistributed to charitable organizations. And then there's non-qualifying DAFs in which it creates a 50-year time limit, but the individual actually doesn't get a deduction until that DAF redistributes the funds to other charities. So once the funds is transferred to the charities, that's when the individual would actually get that charitable deduction. And it also limits the deduction on property. So an individual, let's say you donated a building into a DAF, you won't get the charitable deduction until that DAF actually sells the building. So again, the purpose of these changes is to keep the funds moving, getting the funds out there to charities, and eliminate some of this warehousing that the IRS is seeing in terms of these large DAFs and assets being held. Another area that the ACE Act actually also covers is the excise tax, in which if private foundations distribute 7% instead of their normal 5% required distribution, it would actually eliminate their 1.3 excise tax rate if they did do this higher distribution for the year. So again, a lot of emphasis both on the Green Book and the ACE Act on donor advised funds. This is an area I think that has been talked about for some time. So we'll see what some changes, come about from this.
Thank you, Liz. So clearly lots of efforts in place to get those funds, those philanthropic funds, out into the communities and working. Switching over to Yulia, what can readers of financial statements expect to see this year that's a little different from prior years?
As you might be aware, the Audit and Standards Board has been really busy with updating a lot of standards in the current year. So the ones that go into effect for fiscal year December 31st, 2021 year ends onward is the new reporting standards. Those standards really change the focus of the audit opinion and how it's structured. You will see the reports will look really different from prior year. In the report, the audit opinion section will actually go right at the top, which is the most important section of the entire report. And before it was kind of towards the end and you had to search for it. Now it's right there, right at the top, and everybody can see what type of opinion you got. After that paragraph, you will have your basis for opinion and then some other paragraphs that outline responsibilities of management and auditor in an audit to really clarify who's responsible for what. Now, in addition to the financial statements audit opinions, single audit reports will also change to mirror that same structure with the audit opinion being first at the top. Another change that is going to be implemented as a result of these new standards is in a communication to those charged with governance letter. That is the letter that's required to be distributed together with the audit reports to those charged with governance. And it really outlines certain things like things that the auditors are required to communicate. And if you read it closely and compare it to prior year, you will see that there is a new section in that letter, which is significant risks. At the very least, that one you will see there are some other items that are being considered to be added, depending on the type of the engagement and the results of the audit. So the significant risks section is not new, so do not be alarmed suddenly seeing some risks there. It's not because suddenly your entity became more risky. It's whenever we perform an audit under US auditing standards, there's always a process where you would identify your significant risks and then you tailor your audit procedures to address those risks. It's just that now with the standard, we will be required to outline them in writing in those letters. And so at the very least, you will see two standards there, two risks disclosed there. The improper revenue recognition due to fraud and then management override of controls. Those are presumed risks under US generally accepted auditing standards.
Thank you, Yulia. And yes, I just want to echo what you said about a reader shouldn't be alarmed by this because these are risks that we have to address and we have always addressed during the course of audits. But I think when a reader sees a presumed risk of management override of controls or revenue recognition as significant fraud risks potentially, that creates some alarm. The point really being that we have to disclose them because the risks always exist. We have the obligation as auditors to make sure that we've been able to reduce those risks to an acceptable level through our audit procedures. So definitely read the fine print this year. And in particular, I think in the auditor's report, there's now more definition around what a risk of misstatement is as a result of fraud, because the risk of not detecting is actually greater because of the risk of collusion, etc., and forgery that goes into fraud. So there's some definitions there as well as more definitions around what the risk of or what a material misstatement, how that is defined. And I think that's really an effort because this is arising from the clarity standards, really arising from an attempt to bridge that expectation gap between users of financial statements and the audit. And now back to Amy to make some comments on the lease standard.
So just as a reminder, even though the lease standard was previously delayed, it is now upon us. We have the effective dates for different fiscal years listed on the slides. And definitely talk to your auditors if you haven't yet. Make sure that you've taken a full inventory of all of your leases. And we've also included a link here to GHJ's ASC 842 webinar that our colleagues put on that has all of the details around implementation that you'll need. So definitely check that out. I saw in the polling question that there's a few individuals who are interested in learning more about that lease standard. So we highly recommend viewing the recording of that webinar.
Yes, I echo that because there's some really helpful tips in that. And of course, we also have tools to assist with the implementation of that lease standard to make it seamless and turnkey, because it certainly has been long in the coming, and really the disclosures can be quite burdensome, more perhaps than the actual calculation itself. So knowing what to expect. All right, so Amy, who actually leads our technology initiatives and innovations within our audit department at GHJ, has some suggestions around cryptocurrency, which is one of our last topics. Sorry, not cryptocurrency. I guess I'm going back to the start of the presentation today, but actually all our concerns about cybersecurity, which I suppose links in with cryptocurrency as well. So Amy, if you could just share some suggestions that you have based on your experiences around cybersecurity.
Sure, Danella. So we get asked about best practices around cybersecurity all the time. It's definitely top of mind for most organizations, not just nonprofits. And first tip is just continue to educate your employees, provide trainings. Employee alertness is definitely the first line of defense. And in addition to training, consider sending test phishing emails just to see who is paying attention and who isn't. The second tip that we have is to make sure that you're performing regular updates to all of your computers and servers. This just ensures that your security updates and fixes are all current, which is really key in this environment. And then the third tip is to make sure that on sensitive systems, you're implementing multi-factor authentication and/or single sign-on, and also considering to implement stricter password requirements. So the lengthier and more complex the password, obviously, the more challenging it is to hack. So those are our top 3 reminders to organizations just to keep in mind over the next year.
That's excellent. Thank you, Amy, because we are seeing also more organizations electing to take out cyber insurance. But obviously it's important to understand what is covered and what isn't. And insurance, of course, is helpful after the fact, right? But really we want to make sure that you have all the controls in place early on, particularly in light of the remote, as Amy mentioned, remote world we live in more now, and of course, other political worldwide events that impact the virtual digital space. All right. So let's get to a couple of Q&As. One that I saw pop up, and actually it was, I'll just go back to Amy on the lease standard. The question was, does it apply to all leases?
So it applies to long-term leases. So there is an exception for leases less than a year.
And like anything in the accounting world, right, a materiality does apply. Well, it certainly applies to us, but I think, I think as you know, for our clients that have copier leases, small leases as well, obviously think about the materiality impact as well for small leases. Is that really going to justify all the time, effort, and energy going into that as well? But yes, it does actually apply. All leases have to be assessed. Going back to, there were a couple of questions around the valuation of cryptocurrency. And there is actually a lot of wonderful resources that the AICPA has put out, and there are a number of websites that also provide the highs and lows of cryptocurrency donations as well. So I think when we send out the recording and the materials from today's presentation as well, we will include those resources. And they also include a number of suggestions and thoughts for discussion with your leadership and your development teams as well. Let's see, what else do we have in the Q&A?
There's a couple of tax-related questions in there. So the first one was, does California allow an LLC to be exempt or only corporations? So currently California does allow title holding companies and disregarded single member LLCs to actually apply for their own separate tax exemption and not have to pay your $800 filing on an annual basis. I haven't seen anything whether if it's just the LLC itself that's this main entity receive exemption. Normally, California tends to follow federal regulations. So I'm sure there's something that may come out once on the federal side, there's final regulations as to what constitutes and qualifies as a tax exempt organization for an LLC. And then there was another question, how does the new K2 and K3 forms affect 990 PFs? So if you're not familiar, K2 and K3 are new K1 disclosures for partnerships in regards to foreign tax credits, and it's just additional disclosure, creating a much longer footnote. But again, on the 990 PF side, you are allowed to deduct those foreign tax expenses that are reported within your K1 disclosure to offset it against net investment income, or if it's related to unrelated business income, you're able to take that deduction there. So the deduction is still applicable. It's just more reading that you have to go through in order to get that information.
Well, thank you, everyone. We are now at time, and a big thank you to our panelists, Yulia, Amy, and Liz. And for those whose questions we weren't able to get to, we will address them in the email you'll receive with a recording. Thank you so much for joining us today, and enjoy the rest of your afternoon.